All right, welcome back, everyone. It's time for our first team. Welcome to you from Denver University.
We want to check our ready.
Sure.
Hello?
Hi. Hello.
All right. Can I just go ahead and start?
Yep.
Wonderful. Hello, and welcome to the 13th annual CFA Research Competition. We would like to start tonight by thanking each and every one of you for being here. My name is Isabel Simpson, and I will be presenting to you guys our investment thesis, as well as our business description.
My name is Paul Newbert, and I'll be presenting on our financial analysis.
I'm Jack Delsey. I'll be presenting ESG.
I'm Ivan Richter, and I will be going over the valuation.
Thank you. We're going to go ahead and jump into our executive summary. If I could direct your attention to the investment thesis, you will see we are issuing a sell recommendation on Vail Resorts with a 1-year target price of $243, which is a 9% decrease from its closing price last Friday. Our key valuation drivers consist of 5 major headwinds. This includes 1, growing competition among past products, 2, fixed supply of ski resorts, 3, labor challenges, 4, unfavorable climate change, and 5, the brand image under growing scrutiny. Moving into the business description, I want to first direct your attention to the pie chart on the far right side of the slide. This represents Vail's 2 largest business segments by revenue attribution. Moving your attention to the map, you can see that their mountain segment is far-ranging and broken up into 7 geographic areas. Vail has fueled their artificial mountain segment growth through acquisitions of other resorts, as is demonstrated in the bottom right-hand figure. Unfortunately, this fixed supply of ski resorts is not a sustainable approach. Now, before I move on, I actually want to direct your attention to the mission statement. Vail strives to create the experience of a lifetime. Unfortunately, Vail has been experiencing increased scrutiny for failing to provide the exceptional product quality they're known for. This is demonstrated in the image on the right. What you are seeing are supply constraints caused by capacity bottlenecks due to labor challenges as well as reduced snowfall, all of which is resulting in a contraction of the skiable acreage. Moving on, I want to talk about the demand, specifically the fact that there are an increased number of multi-resort passes on the market. All of these factors combined have resulted in a 2% decrease in the number of skiers Vail has seen over the last season. I'm now going to hand it over to Paul to address our financial analysis.
Thank you very much, Izzy. Vail's revenue saw a meaningful reduction for fiscal year ended 2020 due to the onset of COVID-19 and the subsequent shutdown of their mountain operations for the season. In response to lower levels of travel and demand and the increasing competition among pass products, Vail slashed their pass prices by 20% for the most recent ski season, further adding to the decrease. Vail's operating margins compressed for fiscal year ended 2020. Total revenue decreased by about 14%, operating income decreased by nearly 49%, and overall earnings dropped by 67%. Vail's operating margins are recovering, however, we believe they may continue to face compression factors in the future, which Evan will discuss further during valuation. Vail's asset utilization to generate revenue has declined over the years, even prior to COVID. This is due to the growth of Vail's portfolio of holdings without equal growth of revenue. With regards to short-term liquidity, for fiscal year ended 2021, Vail more than tripled its cash holdings to almost $1.3 billion by cutting expenses, issuing debt, and suspending dividends in order to remain highly liquid. Despite that state of liquidity, Vail's ability to pay its short-term obligations is still below average for its travel and leisure peer group. Regarding Vail's long-term solvency, Vail's interest coverage ratio for fiscal year ended 2021 is 1.9 times. 2 times is the minimum ratio permitted under Vail's primary credit agreement. Adherence to this covenant was waived in 2020, although there is no guarantee that such a waiver will be offered again. Vail holds a BB junk bond rating on its debt, and any breach of its debt covenants, such as interest coverage, could put the company on credit watch with negative implications. The Altman Z-score model, which you see on your right, is a numerical calculation that is used to predict the probability that a company will face financial insolvency within the next 2 years with a 72% accuracy rating. Vail's ultimate Z-score of 2.31 is within the financial gray zone, although significantly lower than prior historical levels for the company. Overall, we do not believe Vail Corporation to be in imminent danger of bankruptcy, but we also don't believe Vail's stock price will prosper under prevailing market conditions within the next year.
All right, thanks, Paul. So regarding ESG, we all know we have to promise it, but we chose to break down ESG as follows. So first, covering environmental, we chose to rate that as a neutral because although they have goals towards zero environmental impact, the nature of the business requires them to consume a large amount of natural resources. Next, on the social, we decided to rate the social factor as a negative due to talent acquisition challenges, low pay for employees. This is evident in the petition signed by about 45,000 people to hold Vail accountable for ski area mismanagement and low pay for seasonal and full-time employees. Next, onto governance, we rated that as a positive. Their board is diverse, it's made up of all independent directors. The latest say in pay vote was 92% or in favor of compensation for those executives. So in summary, we believe that Vail does live by their core values, walks the walk and talk the talk, but therefore there is no apparent greenwashing. So on this slide, we use this Sustainalytics assessment as a proxy for our assessment. So as you can see right there, their ESG risk rating was about a 3 out of 5. Numerically, it's visualized over there at a 27.29. So right in the middle, again, this is below their competition and industry average. On a scale of 1 to 5, 1 being the best, 5 being the worst, they were at a 2, which is almost perfect. And again, this is competitive, is below average for their competition. Finally, the top 3 material ESG issues are product governance, carbon, and resource use. Again, due to all these factors, we do not believe there to be any greenwashes of Vail. And I'll hand over to Evan for the evaluation.
Thanks, Jack. As you can see in the graphic on the right, we identified the key drivers to our investment thesis and ranked them according to their material impact on Vail, as well as the probability of occurrence. The growing competition among multi-resort pass projects, as Izzy mentioned, is a significant threat to Vail's top line if they do not change the current conditions of the guest experience. Vail's desire to expand is problematic as it requires large cash balances, increased cost of debt, and accumulation of debt while limiting their growth through acquisition strategy. Labor challenges and mismanagement of resorts has caused tremendous bottlenecking, which has caused many guests to be very unhappy and will require compression of margins going forward to increase management as well as the seasonal employees that operate the lifts and chairlifts. Going on to the unfavorable snowfall, climate change has been largely unfavorable to snowfall, and as a result has made Vail increasingly dependent on snowmaking operations to open up a limited amount of terrain and also requiring increased capital expenditures going forward. Increased brand scrutiny, as Jack had mentioned, the current Change.com petition is definitely taking a huge hit on Vail. They were previously known as a premier destination for winter recreation. However, they've seriously diluted that brand image due to operational failures that will drive many guests not to return. In our evaluation, we conducted a model with a 10-year horizon and a discounted cash flow value of free cash flows to the firm. Ultimately, we arrived at a target price of $243.42. Through this analysis, we used a scenario analysis with a bear, base, and bull case, equally weighting these to arrive at target price. In our bear case, we see unseasonably low snowfall with a significant decrease in advance pass sales of $400,000 due to guests who are not returning to a poor experience this year. In our base case, we see moderate snowfall with only a slight decrease in pass sales of $100,000 due to Vail's continued acquisitions, mitigating some of those customers that do not return. And in our bull case, we see above average snowfall with a slight increase in pass sales of $200,000 due to Vail's continued growth through acquisitions and many guests letting one season of bad experiences go be looked over. Ultimately, we project a 9% downside return. I'll hand it back over to Izzy to go over our conclusion.
Wonderful, thank you, Evan. To conclude, we would just like to reiterate the major headwinds that Vail is facing today, including 1, growing competition among past products, 2, fixed supply of ski resorts, 3, labor challenges, 4, unfavorable climate change, and 5, brand image under growing scrutiny. Thank you, and we would like to now open it up for questions.
Jack, thank you very much for the presentation, very good. So you guys obviously had a very negative view on the stock. Can't help but notice that in evaluation all cases, you were forecasting strong growth still on top line, if I'm not mistaken. My question is, regardless of stock price of Vail, how do you see Vail Resorts against its competitor peer set? You can include, I don't know, Aspen, Altera, and also, the non-skiing leisure activities. If that was your investment universe, would you maintain yourself?
I would maintain ourselves. Vail, I would maintain our sell position. Vail is a very unique pure play with very few comparables when you consider the revenue is generated by on-site and on-hill activities, and representing 89%, compared to some of those other hotel and leisure companies. Much different business model there. And when you consider Altera, there are much different companies that are not a conglomerate of other resorts, significantly reducing their capital expenditures while providing significant value to holders of those programs.
Also, to build off of that, Evan, can you flip to our slide in the appendix that goes over the competition with multi-pass resort, or multi-resort passes?
Yeah.
This just gives you an idea of the ski industry specifically, as opposed to the travel and leisure industry as well, which was what Evan was referring to on a bit of a broader scale. As you can see, the Epic Pass gives you the middle amount of mountain access. Additionally, they provide the smallest number of additional days. These days are in addition to the season pass, which is offered at their resorts.
Thank you for the question.
Hello?
I'm a long-term investor, and my target is not to look at the price for the next 12 months. So if I'm a long-term investor and I'm looking at this property from a long-term return potential, would you make a case for investing in this company today for the long-term investment return? What would that be?
I would say no, because over the last year, COVID has uncovered a lot of bodies with Vail, and is one reason they've increased their cash position so much. And the tools they use to increase that liquidity, they don't have those tools to dispose of again. They have a double D junk bond rate. They're not able to issue that bond at a continued rate. They're facing variable interest rates going forward when considering raising more debt. Their strategy is not going to continue to work out due to the saturation of the market and the decentralization of the market.
So you are a short-term here and a long-term here?
Okay.
Yes.
Just to give a bit more emphasis on why we do have that long-term bear view, it's clear that there is a strong demand in the ski industry. People clearly want to ski. What we're seeing happening is Vail can't match the demand with the amount of supply they have. Now, they've been coping with this in the past through acquisition, but there are clearly only so many ski resorts for them to acquire. So as they're reaching this cap, we do anticipate their supply and demand issues to get stronger or larger.
And one more thing I'd like to add too is that their strategy for the better part of the last decade has been growth through acquisition, but as we mentioned, as far as their asset turnover and their ability to generate revenue through those assets, that has been declining over the same period. So we've obviously reached some type of threshold, or in our opinion anyway, and that's another reason why we overall bearish as part of the strategy.
Right, and then just really quickly, just to touch on management inefficiencies that I believe will continue. As you stated, they're growing aggressively through mergers and acquisitions. I believe that as they continue to grow, get bigger and bigger with, or however many miles they want in the next 10 years, unless they grow management at that same rate, I think they're going to have a tough time, like really just managing all that they have on the umbrella.
I will also add, that's why we make the distinction when we refer to Vail's growth as artificial growth.
Thank you.
Are any of you skiers?
I think all of us are skiers here.
Okay, and are you familiar with the Epic versus the Icon choice? Okay. Because I don't know, you're comparing, where are they going to get additional competition from in a realistic sense where there's premier properties? And can you talk about the difference in the demand and the under-management, call it, at the ski resorts, say in the East and Midwest, versus at the destination locations?
Totally happy to answer that question. So as far as when you're comparing the Icon Pass and say the Epic Pass, at the price levels we're looking at, the Epic Pass, they do offer the Locals Pass, which we believe to be the significant amount of those pass sales, even though those aren't disclosed. The reason being is we think that individuals in Colorado are definitely taking advantage of that, but the value proposition isn't as great in the Midwest, on the West Coast, on the East Coast. These other pass products are focused on those regions. Icon Pass very much focused on the upper Rocky Mountain region, not as much Colorado. Areas, I will also note that suffer from less, I guess, unforeseen snowfall. They have better snowfall. It's a lot more consistent. There is still plenty of those destination resorts, whether it's Jackson Hole, Big Sky, resort properties that have lots of room for families and those ancillary spending. But ultimately, you just get a much better product from the Icon Pass, given the value you're going to have on the other areas. The East Coast offerings are much greater. The West Coast offerings are much greater. The only real reason we proceed to have an Epic Pass is the Epic Local Pass here in Colorado, which in that sense, you're really not buying any of that additional value to go to other resorts.
Yeah, I would also like to build off of that by saying that Vail has a wide addressable market that can be classified as the destination guests versus the regional guests. And I think that the competition amongst regional guests is more applicable in terms of the Epic Icon and the other pass offerings, whereas the destination base is definitely a strong moat that Vail has. But again, if they can't maintain or continue to support the amount of demand that they have, they're not going to be able to pull it off.
Thank you for the question.
I can just ask, and I apologize if I missed it, but when I think common theme of the questions that have been asked is, if Vail's going to be a loser, it's kind of a closed sector, so someone has to win. Have you done any type of analysis in terms of peers, in terms of, there was talk about the junk bond rating, obviously that's a concern if rates go up. Do other resorts have a different junk bond rating? How are the performance metrics that you're using to take a bearish view on Epic compared to, like, say, Icon or these other companies? Is there evidence that they're outperforming and they're doing it better, and therefore they're in a better position?
That's a great question. Thank you for asking that. Because Icon is privately owned by Alterra, that's not information that we do have access to.
I would also like to add that Epic, unlike its other competitors, is what we classified as vertically integrated, meaning that the passes that they're selling are giving access to resorts that they own, which is the main differentiator between them and their other pass products.
Thank you for the question.
I just have a more general question for you. Y'all seem very critical of the management team. Do you think a new management team or a new strategy could change your view on the company? And with that, it seems like Vail took a pretty aggressive approach here, cutting prices by 20%. Do you agree with that decision, or do you think that they should have cut prices higher?
So, and I'll let you answer about the cutting the pass price, but regarding management efficiencies, I don't think there's any issues, like, really fundamentally with who they have in those management role positions. Like I touched on earlier, I just really think that as they continue to grow and acquire more ski resorts, they're going to have a tough time scaling that. I think you're going to really see the product quality suffering, as opposed to maybe if they had half resorts that they could really focus on, wanting employees a higher wage, managing the ski areas properly like they used to, and so forth.
Jack, may I build off of that?
Yeah.
Evan, can you go to our slide that represents the change.com?
Yeah.
So it's very clear that Vail is under scrutiny right now. One way that they could get out of this situation is if they were to replace management, because it would be giving people more faith that they are making these big changes. With that said, if you jump to the next slide, Evan. I'm sorry, one more. Keep going. We're going all the way to the slide that talks about what they're doing to increase guest experience. Evan's jumping to a slide that shows you some of the material changes that the management is making to solve these issues that we're discussing. Yes. But I will hand it off to Evan to address the final question.
My apologies
Just
here.
bear with us for a second.
Yeah, I don't have my laptop in front of me.
That's all right, Evan, we have 30 seconds, so if you want to finish answering the question, that's quite all
As far
right.
as the 20%, when the analysts asked that on the earnings call, they didn't have a direct answer for that. As much as Vail wants to talk about being a data, AI-driven company with all the things they're introducing on Hill to produce pass lines, they really definitely didn't take any sort of quantitative approach to that. And we think that's definitely suffering in product quality. A little bit of anecdotal evidence. They fired let go during COVID, their 25-year operator of grooming. So they're definitely not looking at this from a product quality standpoint. They're definitely looking at it from a recurring service, recurring revenue that's sort of run the product quality. They have a current goal of getting advanced pass sales to 75% of lift revenue. Currently, that makes about 46%. And if you look at the numbers in the industry, they would have to capture about 50% of the total TAM, which doesn't make sense in such a fragmented industry when there's so many different product offerings. There's 462 different mountains. If they're trying to obtain, let's say, half those skiers with 40 resorts, it just doesn't add up in economic sense there.
All right, we're gonna call time. Thank you, pioneers.
Yeah.